20 countries, one currency, and no exit door. In 1999, the architects of the euro sold 340 million people a bold leap into a shared future, an economic superpower intended to rival the United States. But what they didn't reveal was that the men who designed it knew before the ink even dried that it would eventually tear Europe apart. This wasn't an accident, it was a matter of mathematics. The warnings weren't just hindsight, they were filed in academic journals in 1961, in Foreign Affairs in 1997, and in classified government memos long before the Maastricht Treaty was signed. The euro wasn't a flawed experiment, it was a structurally guaranteed disaster with a slow fuse that is still burning today. To understand why the euro was destined to crack, you must understand a concept known as the theory of optimal currency areas. In 1961, Robert Mundell published a paper outlining the conditions under which a group of countries can safely share one currency. He established a checklist of 4 essential conditions. Labor must move freely between countries. Capital must flow where it is needed. Wages and prices must be flexible. And most critically, there must be a central fiscal authority, a shared treasury that can transfer money from prosperous regions to those in crisis. Think of it like a single nation. When a disaster hits Mississippi, federal tax dollars and FEMA funds flow automatically from Washington to provide relief. The U.S. dollar survives because the United States is a fiscal union with automatic stabilizers. However, the architects of the euro knew Europe met none of these conditions. Labor mobility is hindered by language barriers and cultural attachments. A Spanish worker cannot simply move to Germany as easily as a Texan moves to Florida. Furthermore, there was no central European treasury or shared unemployment insurance. The founders built a currency union without a foundation, a house without a basement, and called it architecture. Milton Friedman, the influential 20th century economist, warned in 1997 that the single currency would increase political tensions rather than reduce them. He predicted that a one-size-fits-all monetary policy would devastate weaker economies while barely affecting stronger ones. He was laughed at, and the euro launched on January 1, 1999 to champagne and self-congratulation. But the structural flaw had a specific mechanical trigger. Before the euro, interest rates in countries like Greece, Portugal, or Spain reflected their actual risk. Investors charged them 10% or 12% on government bonds, which disciplined government spending because borrowing was expensive. The moment they joined the euro, markets assumed these countries were backed by Germany. Interest rates converged almost immediately. By the early 2000s, Greece could borrow at roughly the same rate as Germany, practically free money. This led to massive borrowing. Greece funded a bloated public sector and unsustainable pensions, while Spain and Ireland fueled spectacular real estate bubbles. In a normal country with its own currency, these imbalances correct themselves through devaluation. The currency falls, exports become cheaper, and the economy adjusts. In the Eurozone, that escape valve does not exist. You cannot devalue your way back to competitiveness when you share a currency with Germany. The only option is internal devaluation, crushing your own workers with austerity until wages fall enough to compete. This process takes decades and carries an extraordinary human cost. The productivity gap between Northern and Southern Europe widened every year the euro existed. Because the South couldn't devalue, they fell further behind, financing their deficits with borrowed German money. Harvard economist Martin Feldstein argued that forcing diverse economies into a single monetary straitjacket would generate nationalist resentment. He was right. The Greek crisis didn't just cause economic pain, it destroyed trust. Germans labeled Greeks as lazy, while Greeks portrayed German leaders in Nazi uniforms on protest banners. The disaster became a human reality in 2009 when the Greek government revealed its actual deficit was 12.7%, far higher than reported. Bond markets panicked, and default became a mathematical certainty. The IMF and European Central Bank arrived with rescue packages, but the price was the most severe austerity program in peacetime history. Wages were cut by 30%, pensions were slashed, and healthcare was gutted. Between 2008 and 2013, the Greek economy contracted by 26%, a devastation comparable to the U.S. Great Depression, but compressed into 5 years. Youth unemployment hit 60%, and suicide rates soared. The IMF later admitted its models were wrong. They assumed cutting government spending would have a minimal impact on GDP, but the reality was that every euro cut destroyed €1.50 of economic output. Yet none of this mattered because Greece had no alternative. Without its own currency or a fiscal transfer mechanism, its only choice was to crawl until the broken leg of its economy healed itself. Cruelly, by 2015, Greece's debt-to-GDP ratio was higher than when the crisis began. The medicine made the patient weaker. The ECB, based in Frankfurt, sets one interest rate for 20 very different economies. This is a fundamental impossibility. In 2003, Germany was struggling and needed low rates to stimulate growth. Simultaneously, Ireland and Spain were overheating and needed high rates to cool their housing bubbles. The ECB set one rate that was too low for Spain, pouring gasoline on its fire, and only marginally helpful for Germany. By 2011, the roles reversed, but the problem remained. One central bank cannot serve 20 masters pulling in different directions. The deepest layer of this failure is that the euro was built to work for Germany. Germany's economic model relies on exports. Before the euro, the Deutsche Mark was so strong it made German exports expensive. The euro solved this by merging the disciplined German economy with the rest of Europe, resulting in a currency weaker than the Deutsche Mark would have been. Germany gained a permanently undervalued currency, allowing it to run the largest trade surplus in the world. This surplus was then recycled back into the periphery as loans from German and French banks. When the crash happened, the bailouts didn't rescue Greece. They rescued the banks in Frankfurt and Paris, using Greek citizens as collateral. The euro crisis was never resolved. It was merely postponed. Today, Italy carries a debt-to-GDP ratio of 137%, and its economy has stagnated for 25 years. The ECB has expanded its balance sheet fourfold to suppress interest rates and prevent markets from pricing the true risk of Southern European debt. The system is held together by central bank interventions and the implicit promise that Germany will back the debts of its neighbors, a promise the German public has never ratified. The architects of the euro hoped that monetary union would force the creation of a United States of Europe. They described the euro as a bicycle. If it stopped moving towards political union, it would fall. The bicycle has stopped. It is being held upright by increasingly desperate and creative central bank interventions. The greatest mistake wasn't the ambition of the project, but the refusal to acknowledge its failure. Instead of redesigning the architecture, institutions doubled down, punishing the patient for the disease. The euro was sold as a path to prosperity and unity. Instead, it built a cage, too expensive to escape, too fragile to last, and too politically loaded to repair. Money is not just accounting, it is power, and the euro was designed to concentrate that power in ways that were never put to a democratic vote. The bicycle hasn't fallen yet, but it has never been further from its promised destination.